Hello and welcome to Commodity Champions. I'm Manisha Gupta. It has been a huge week for the commodity space in India as NSE launched its commodity exchange today. The exchange will initially focus on the non-agro commodities and has launched 3 categories: gold for 1 kg, gold mini for 100 grams and silver for 30 kgs. For now, the delivery center is Ahmedabad, but NSE is in talks to spread it to other centers and states as well. Remember, it was BSE that had launched this version on commodities on 1st of October, but it is NSE that has been, of course, has had a big bang launch for commodity space today. CNBC TV18's Yash Jain caught up with the MD and CEO Vikram Limaye, and he said that the exchange is in talks with SEBI to launch second tranche very soon in sense of metals and Brent crude, and is awaiting approval from SEBI as of now.
You've entered the commodity derivative segment with gold and silver. Help me understand, how do you expect these two commodities, what kind of entry would this give to NSE as far as the segment is concerned? Also help me understand what are the second segment, the second phase of commodities that you would look at, and is there any sort of target that you look to achieve before you launch the second set of commodities?
So we have already filed for product approvals in 2 other commodities with SEBI, and we are awaiting approvals. One is in the energy space in crude oil, and the other is in base metals and copper. So once we get those approvals, we will launch those contracts as well. Today we've launched gold and silver, and those are very large opportunities. As you know, in India, the gold market is a very large market, and I think if it is developed in the right way, the kind of contracts and the volume that gets traded on exchanges can be a significant multiple of where we are today. Absolutely. Including the fact that over time we should aim to be the price determinant of gold in the country, given the dynamics surrounding gold in India. So our objective in getting into this segment is really to take a long-term view of the commodities market and to develop the market in the right way in terms of getting the hedging community to participate and to make sure that we have the right standards in India so that everybody is comfortable, trading commodities and pricing commodities based on the quality of commodities that are available in the country.
Right. A key determinant here is going to be the volume in terms of the kind of response which you get in terms of both commodities. Help me understand, is there any sort of market making scheme in terms of shoring up the volumes, or any other scheme that you're looking at towards that direction? And second thing, you'll have a competition straight from a few exchanges now in this particular space. Is consolidation something that we can look forward to in the exchange space?
So we haven't announced any market making scheme for commodities. I do believe that for members, trading on NSE would be hugely beneficial, because many of them are already trading other segments on NSE. And as you know, the volumes on all the other segments on NSE are very large. And trading one more segment on the same exchange has a lot of efficiencies in terms of whether it's relating to collateral, whether it's operational efficiencies, capital efficiencies. So I do believe it would be beneficial for people to also trade commodities on NSE. As I said, right now we've launched 2 contracts, 3 in gold and silver, and we have applied for crude and base metals. Once those come through, we will launch those as well. Right. And agricultural commodities will be in phase 2. So I don't foresee us launching agricultural commodities in the next 6 months, but after that we would be open to looking at agri commodities as well.
On the point of consolidation?
So on consolidation, I cannot comment on it at this point. We'll have to see how the situation evolves, and if there are opportunities that make strategic sense, we are open to inorganic opportunities.
Thank you for that, Yash, and then also dip into what the stakeholders said on this launch today at NSE.
The regulator is doing its work for nurturing liquidity and nurturing this market. It's for the exchanges to really do hard work, to have good commodity derivatives on their platform so that it benefits the value chain participants as well as the entire economy. There's a whole lot of participants, segment of participants that are awaiting, and only thing is that we have to have a real solid database, and then our focus on them, educate them, train them. When they derive the benefit of price risk management, then only you can have a successful commodity derivative segment in this country.
Exchange में commodity launch करने के लिए और volume ज़्यादा से ज़्यादा generate करने के लिए NSE को और IBJ को और बाकी सब लोग को SEBI के साथ मिलके एक मुहिम चलानी पड़ेगी. डब्बा ट्रेडिंग को बंद करना पड़ेगा. जितनी जल्द से जल्द डब्बा ट्रेडिंग का जो ट्रेड पूरे देश में उसका वॉल्यूम इतना ज़्यादा इंक्रीज़ हो रहा है और उसका नुकसान कहीं ना कहीं एक्सचेंज को भी आ रहा है। एनएससी से भी गुजारिश करूंगा कि सरकार के साथ स्पॉट एक्सचेंज जल्द से जल्द लॉन्च हो, इसके लिए भी मुहिम साथ में चलाएं।
Well, joining to talk about all of that is Mr. Surendra Mehta from IBJA. Mr. Mehta, hi, thank you so much for joining us. First of all, what have you read into the NSE launching commodity derivatives today? And that also, the beginning, of course, has been with gold and silver, and IBJA also has had a tie-up with them. How does the whole scenario look to you now?
See, commodity derivative is a big market, and we are looking for a very big volume of the gold on this commodity exchanges. That is why IBJA has tied up with the National Stock Exchange. National Stock Exchange, as we all know, is one of the largest stock exchange, and we foresee that in commodities also they will do a very big business. But the only issue what is concerning us today also is about the dabba trading, and I think the ministry and the government needs to really penalize the people involved with the dabba trading, because most of the volumes of the exchanges have been taken by these dabba traders, and once they are heavily penalized or prosecution provisions are made for that, probably the exchanges would do a better volume, because now there are almost 4 exchanges, and these exchanges are in the equity you will find now only 2 exchanges, but in commodities now almost there are 4 exchanges, so the volume is required.
That really was my next question. You know, with especially the latest exchanges, as NSE also has said today, that they are waiving off transaction charges for the next 3 months. Do you think that is going to be one of the key drivers that would ensure that we see a decline in dabba trading, as the transaction charges are not there? Do you see that as an encouragement?
No, that can be an encouragement only for the people who do transparent business. They might shift from one exchange to the another by waiving, if one of the exchanges waive off the charges. But as far as dabba traders are concerned, there are no charges in dabba trading only. So there is no question of they shifting to any particular exchange if that exchange waives off the charges. Dabba trading is a very, very serious issue, and I think all the exchanges and all the gold associations put together needs to address this issue and needs to go to the ministry and find a solution to this problem.
You know, I'll of course want to ask one more thing on that, but before that, would you say that with now 4 exchanges giving commodity futures as an instrument, as a way to trade, are the markets now spoiled for choice? Do you think there is enough participation, enough market share for all of them to be in the space?
Well, currently this is definitely an issue. If you look at the gold market, we import about 800 to 900 tons every year, and there is almost 300 tons of recycling. So the average volume, average yearly volume of gold is about 1200 tons. But if you see yesterday's news, in one of the exchange, the 15 tons was hedged, and it was the largest hedging ever done on the exchanges. So I see there is a lot of scope for all the exchanges, but government needs to intervene and take some stringent measures against the people who are working outside the exchange.
Mr. Mehta, also the other thing really is that as the SEBI member pointed out today, that it's not that all the stakeholders are, part of these exchanges. They are not trading. There's not so much of hedging happening. What really do you think needs to be done to push that? Because as of now, we understand there are some major brokerages perhaps dealing in this, some major companies or jewelers perhaps part of this gold and silver trading here. But to ensure that the tier 2, tier 3 cities are part of it, that smaller brokerages are, standalone brokerages perhaps are part of this as well, how would the exchanges or you as an association ensure that?
See, we have been regularly conducting the risk management seminars along with the exchanges. That is one of the measures can be done by the association. But what RBI needs to do and what SEBI needs to do is to have a compulsory regulation whereby any money borrowed from the bank in respect of gold must be hedged with the bank. There are some of the regulations, but they are not strictly followed, and the banks needs to look at this.
You know, even as we are talking about, of course, the new launch, it is the gold prices itself which has been quite in news in last 24 hours. We are trading at more than 2-month highs in the international markets. The Indian gold price is closely nudging towards that 32,000 mark. What is your sense that finally this space will see investment?
Definitely. If you look at the Indian market, the people have been looking for the safe haven. There have been fall in the stock prices. There have been fall in the real estate prices. People have been withdrawing money from the mutual funds, from the debt funds because of failure of NBFC. The only option left to them was bank deposits, wherein you get hardly 5 to 6% interest. So gold is still considered to be the safe haven, and I think people are moving at least in our country to a safe haven. Secondly, if you look at the world market, the stock market have been volatile. The currency has not been doing great, and the Fed, we don't know really Fed will increase rates or not increase rates in the near future. So all these positions clearly gives gold as the safe haven.
Mr. Mehta, one final question before we let you go. Explain to us on what the government, the regulator, the exchanges and you as an association really need to do now when it comes to the precious metal space. I mean, we've already seen government come out with the sovereign bond scheme as well to ensure the festive demand. Some of that at least comes this way. But, you know, the kind of scenario that we are working with right now, where, yes, there is buying of gold happening. There is an expectation that we may perhaps see a gold exchange or a gold regulator, etc. With so much happening and so much expected, what is the way to go forward into this sector?
One thing needs to be understood that in a country like India, it is very difficult to stop the demand for the gold. And earlier also it has been tried, but this is not a method because it gives a public outrage. So what can be done is that the investment demand can definitely be shifted to products like sovereign gold bond. We have been recommending for a long time that the government needs to start the gold saving account and gold recurring deposit account. I think once gold saving account and recurring deposit accounts are in place, the physical demand will slowly and gradually shift to this to the recurring deposit account.
It hasn't just been about gold and silver and crude. The metal prices also were very, very volatile. We, of course, were tackling with the global sell-off in equities, and then IMF coming out with a report saying that they also are downgrading demand for the global growth for 2018 and 2019 as well. And then, of course, markets also had to look at the Chinese trade data that has been slightly on the positive side, and that, of course, led to some buying today. But overall, this is yet another week which perhaps is closing in the negative for many of those base metal prices, barring perhaps zinc, which saw a huge turn-up coming in. But joining us to talk about the industrial metal space now is Julian Kettle from Wood Mackenzie. Julian, hi, really appreciate your time. First of all, how have you seen the global events in this week? Would you say that finally we are looking at the US-China trade war concern impact being seen into the markets?
Well, it certainly fed through to market sentiment over the past 3 months. So, and that's the reason why we had such a significant sell-off. I think the markets have digested what has happened so far. The sentiment in and around LME week has been broadly neutral as far as the commodities are concerned, and that's across the board.
Julian, you of course are at the LME week, and this is a place where all global experts meet, talk about the demand and supply scenario going forward for the year in metals. What is the sense really coming in? What are most people bullish on right now?
Okay, so always copper, the world's favourite metal, but not for the short to medium term, perhaps for the slightly longer term. So as far as the copper market is concerned, our view is that the market will be essentially balanced over the next 2 to 3 years with the rise in supply matched by or offset by the rise in demand. It's not until the early part of the next decade where the critical shortage of supply will become apparent. So this is just the lack of investment, and that's a consistent narrative across a number of base metals. The fact that the miners have been unable to press the button on expansions over the past 2 to 3 years, and it's going to come back to bite them to some degree. So aside from copper, we have zinc, which is in structural undersupply, both at the mine and the refined level. The key question there that people are talking about is whether smelter utilization rates will be able to rise to prevent further shortfalls in the market. So we're pretty bullish on the zinc market. Ditto lead. As far as aluminium is concerned, obviously trade wars and the trade impact is having a significant influence. We also have challenges on the raw material supply chain out of Brazil.
Sure.
And then overlying all of this, you have China's environmental policy.
Julian, also comment on the fact that we are looking at a lot of, as I asked before, a lot of trade tariff concern. That impact seems to have been coming into the market because there are goods now getting out of China, getting out of US, which do attract all of those tariffs. Do you see a significant impact of that, or would you say that the current prices have now factored this in?
Our view is that the current pricing levels have factored in the issues of trade. It's a case of let's wait and see if there is a significant impact. As I mentioned, over the past 3 months, there has been concerns that the trade wars, for want of a better phrase, will significantly impact demand. Our view is that net there won't be a huge impact. China becomes a little bit more China-centric, the US a little bit more centric, but the key challenge is just, again, the lack of supply growth. As far as aluminium is concerned, the US hasn't seen a significant increase in domestic supply as a result of restrictions on imports, and that represents a challenge.
Julian, while of course the current demand will continue, it is all about the electrical vehicle demand. That of course would be the major boost in sense of the demand going forward. Is there enough metal around for that? I mean, we've seen the cobalt prices run up. Same has been the case with lithium in some sense. Nickel prices in the first part of this year did run up because of the sentiment change there. How have you analyzed that scenario?
As far as the EV market is concerned, we are relatively conservative in terms of EV pickup. So, for example, by 2025, we think that EVs in all their forms will represent around about 13% of sales. That's all. Why are we so negative on the growth of EVs? It's a lack of infrastructure. It's the challenge of battery costs. We then have raw material supply chain issues. So if we start thinking about the copper market, for example, where we believe that there's a supply shortfall of around 4 million tonnes in the middle of the next decade, around about a quarter of that is as a result of EV growth in the auto sector. As far as the lithium market is concerned, we have growth of around about 500,000 tonnes in terms of demand from EVs. But the problem is that's been more than matched by supply growth. And if we look at the forward trajectory, we think the lithium market will be in oversupply for at least the next 2 to 3 years, which will obviously subdue prices. It's the same story in cobalt for the short, medium term, but in the longer term, there really is an issue in terms of a lack of cobalt supply, which is why battery manufacturers are starting to design cobalt out of batteries. It represents a huge risk to the pickup in EVs.
Absolutely. Julian, I just want to come back to the metal specific question yet again. You did say that you were most bullish perhaps in copper. That is where you see the best demand emerging. So going forward from here, we are approaching the year end and most of these metals seems to be closing or headed for a negative or a flat close for 2018. How much, portfolio diversification, rather portfolio allocation do you see in metals coming in, or would you advise going forward from here? And how much of a gain or loss would you really be looking at?
If we were to run through the metals, we're essentially looking at flatlining in copper, flatlining in aluminium, flatlining iron ore. Nickel actually represents the greatest upside potential, perhaps a doubling of prices over the medium term. But that's just because it's from a very, very low base. Steel prices, we think, are on a downward slide. So, for example, HRC in the US, we think will go from around $920 a tonne down to $820 next year. So for the short, medium term, there really isn't much to choose between the different metals. Zinc might be a slight outperformer. As I said, that really depends on supply growth and the ability of the smelting sector to raise utilization rates.
Well, that point is well taken and noted, Julian. Thank you so much for joining us today with your sense on all of that metal space and what really is happening as a dialogue in the LME week this time around. So clearly, as Julian says, it is copper and iron ore prices which can be quite flat, including aluminum. The best bet clearly seems to be coming in case of nickel as we go ahead from here on. But with that, that's all the time that we have on this edition of Commodity Champions. Thank you for watching.